Good afternoon, everybody. It's 1 p.m. on the 10th of April. Just recording myself today, so going to spend some time, give you an update. Lots certainly going on in the world, so I want to try to cover some of those things. I've had a volatile week since we recorded last Thursday. We had some pretty big changes and swings, lots of tariff talk, lots of things to cover. So just as we get into it, I'm going to go through a few pages of slides, but going to give an update on, I guess, the last 5 trading sessions and give you a sense of what's going on. So we recorded this a week ago. The first day of the correction starting to happen, the day after the tariff announcements. And after that, we saw a correction Thursday, followed by further market sell-off into Friday, quite material. President Trump continuing to say no changes to his stance on tariffs. And then we came into Sunday night, pretty volatile, big down moves in the futures market. Dow was down about 2,200 points into the early evening of Sunday. As we got ahead to the morning, things started to get a little bit more calm and settle down a bit. We had a volatile session again on the Monday, and then stocks traded down, up and down quite a bit further. And then into Tuesday's session, we were down further. And then we fast forward into yesterday, and the sometime early afternoon yesterday, President Trump said that all of the tariffs will be reduced to 10% temporarily, 90-day hold, with the exception of anything outstanding, which is where Canada and Mexico apply, and that they would continue to increase their tariffs on China because China is being combative with their view on the tariffs to pay. So that is where we were, and what transpired after that is it sparked a massive stock market rally. Kind of the most aggressive move that I've seen, I think, in my career, where we saw NASDAQ down maybe a couple of percent yesterday and finished the day up about 12. So huge intraday swings, lots of action, lots going on there. And below the surface, there's many other things to pay attention to. So if you followed the daily, one of the comments that I put in today's is just around what's going on in the Treasury market. So I've had a fair number of calls from clients just about what's going on in the Treasury market. So that would be U.S. bonds. And one of the things that typically happens when you get a market correction is you get U.S. bonds going up, you get the U.S. dollar going up in that backdrop. And what we had the previous couple of days is we had the U.S. dollar going down, and we had U.S. bonds going down, yields up, yields higher. And so there's a bit of concern just about what's going on there. There is some thinking that some of the big governments of the world have U.S. dollar debt that they hold. So I think one of the things that's important to think about, there is a fear that potentially China's going to dump all of their U.S. dollars, their U.S. bonds. They have something around 760 billion of bonds. That was closer to 2.2 trillion about 2 years ago. So they've certainly been divesting, either buying assets or using those dollars. So I don't think there's a huge concern that we're going to see that. More likely what we've seen is Japan would be the other big holder of U.S. debt. So in order to help manage hedge funds in the world right now, a lot of hedge funds historically borrowed in Japanese yen at zero, put the money into U.S. dollars, and hedged out the interest rate risk. And that gave them the ability to have a tremendous amount of leverage into the market. So as the market goes up, you get obviously benefits of compounding by leverage. But when you get a correction and a material move, which we've seen here, we saw that trade start to unwind. So that's a big reason why you've seen that the U.S. bonds volatile as well. Another piece to look at, which I talked about briefly in today's, was this basis trade. So hedge funds were using leverage in order to participate in the the arb between short-term bonds and the futures market. So they're benefiting from picking up, 5, 10 basis points by doing some type of trading into that market. And when we get a dislocation like we've seen today, you get concerns, volatility there. So lots of things going on below the surface and to pay attention to. Overall, I think it's increased volatility, of course, and the growing concern that potentially Chair Powell's going to have with what's happening in the financial system. So once we start to see the risks in the Treasury market, which we're seeing right now, it has an impact on the financial system, how the banks lend to each other, how the prime brokers work together. And it's really we've seen these events happen historically where we had Silicon Valley Bank, where there's concerns in the system. They started to stop trusting the banks, so their overnight borrowing ceased. Obviously, 2008 was the biggest one. So I think you'd be seeing a number of the global central banks watching and monitoring that closely. And I'd say the longer we see this elevated volatility, the more likely that we see some kind of intervention from the central banks of the world, where Canada has been cutting interest rates and putting themselves in a position to use quantitative easing, which effectively just means intervening in the market and kind of keeping yields normalized. So Canada's put themselves in a position to do that. The U.S. central bank probably has the most room to go because they haven't done any really material interest rate cuts or any material buying of assets. So they've reduced their balance sheet by about 1.2 trillion. So they do have powder as well to participate. So these are things to look at and pay attention to. My view is, though, when markets have a massive dislocation like we're seeing right now, it presents tremendous opportunities. So I've been as active in portfolios looking at repositioning, making adjustments as I've been in quite some time. I know I spoke with many of you, and certainly if you have more detailed questions about the individual portfolios and what I'm looking at, please let me know. But that's a quick snapshot on what's gone on in markets over the last 4 or 5 days. So lots of action to pay attention to. So I'm going to jump into a couple of pages of the slides and then wrap it up with what I see ahead and what I plan to do. But that is a quick update to think about what's going on. Okay, so as I mentioned, we are at April 10th. Anything that happens after now, I certainly can't comment on. But I think what's the most important, and so this would be, I haven't actually pointed at, what number of market correction I participated in now, but I started in 2000, so 25 years this summer since I started. Obviously, the first one would have been the tech wreck of the 2000s that I remember quite vividly, which was when Nortel, JDS, those companies started to correct materially, then been through a number of others since then, and some pretty vicious ones as well. So I often get the question around what happens, what do you think? Is this one different? How does it compare to other ones? And what's the likely path ahead? So I thought this was a great chart just to think about what happens after you see big drawdowns. And so the point around the reason for the drawdown, I think, is pretty irrelevant. I'm happy to obviously discuss geopolitical and ramifications and changes, but I think it's important just to take a step back. And so in 1979, we had a 16% drawdown. The total return after that was 45%. 2009, big drawdown. And then the next the return on the other side of that was 35%. So anytime you see a big drawdown, you increase your likelihood of buying at a better price and then increase the potential return profile of the investment at this point. So this is the TSX as an example. And so I think the TSX is a great reference point to think about. And as markets correct, looking at the index is probably the best thing to do. In Canada, we'd have exposure to the financials and energy. Those would be the key pieces, a little bit metals and minerals. So this is worthwhile just to think about after a drawdown, what's the likely path ahead? And I think that's key to remember right now. So this is the TSX annual return distribution from 1957 2024. I know it's a long time to look back on and think about, but I think it's important just to say what happens when the market drops material 10% or worse. So I think that this first one here is worthwhile looking at. The annual return distribution afterwards increases quite positively. Down in general, it's even better. So I think it's important to remember that when we do see these types of corrections, while they typically don't last a tremendous amount of time, it's important to remember what the likely path is ahead. And so, again, another great one to think about because I am starting to get questions around what happens if we go into recession, what's likely to happen to portfolios. And again, I think this is a simple way to look at it, but just a time to think about what happens when we're in a recession, the 12 month before a recession, what happens to balanced portfolios during a recession, and what happens 12 months after. And then I think a great way to look at it is just kind of that full period as well. And so 2007, 2009, I think is a good way to look at it. 12 months before the recession, what happened? And then during a recession, because 2008, 2009 was a material correction. And so during that recession market, balanced portfolio was down 15. In 2020, where we had a steeper, we'll say, recession period, 12 months before market went up, and during, it actually had a positive return in portfolios. I think on average, this is probably a reasonable way to look at it. But during the recession, what happens to a balanced portfolio? Pretty neutral. But the 12 months after, and we'll say the full period, was quite significant. So 12 months after is 10% return. So by participating when the market goes down and being active, adjusting the portfolio towards taking advantage of assets at a better price is really what's going to put you in a position to benefit as things bounce back. Yesterday was a huge move higher, and any additional equities that put in portfolios rallied materially and that helped portfolios bounce back. So I think it's important to just start to think about, step back, what do we do in this environment? This is a very important time. As I've mentioned in a number of my dailies, there's weeks and years and months sometimes that you don't need to do anything. But this time right now is very important to say, what do I own? Why do I own it? And is there an opportunity to make some switches to make sure your portfolios are positioned for what I think is coming ahead? As always, as well, the opinions expressed in here do not necessarily reflect those of NBF. You should always consult me or your financial advisor. If you have any questions at any time, feel free to reach out either to Eva or I, and we're happy to book a meeting and or address any concerns that you may have. So this would be the point typically where Eva would ask me what's going on next week. So I think it's a great thing to think about. Obviously, it's big picture from a perspective of I'm thinking about what's happening today. Where we sit here today, we got the Dow down about 1,900 points and the TSX down 900. So I think it's important to think about what's happening right now and today, looking at the plenty of opportunities that are being presented and trying to make a good decision on should we add, should we buy, what is appropriate now given what's going on in the world. So I'd be looking at every holding that we have and assessing whether it makes sense to maintain them, add to them, or sell them. So lots to do. Pay attention. Coming into this week, we were in the about 50-50 chance of whether they're going to cut rates or not. Well, it still looks like that's the case right now. Monday we'll get a revised number. I'd say we'd be leaning more towards rate cuts because inflation expectations and both inflation reports have come in a little bit lighter than expected, and that's what I mentioned last week, where I think it's more disinflationary, deflationary. Still stand by that. So we'd be watching those data points quite closely. The Fed doesn't meet until the first week of May, so we'd be looking to see as well how many rate cuts are going to be priced in. presently, given the anxiety in markets, you're looking at a 1% cut this year in the US. So that'll be important to watch and plenty to cover there. As for the adjustments, tariffs, tax, I think these are going to continue to play a material role in the volatility of the markets, but really that is an opportunity to say what and how do we make sure we're participating when the things go up. The one comment that I've always made this year and continue to support and think is that money supply will increase. So you can look at it on various ways. There is M2, which I've talked about, which is total money supply. We see that going to have positive tailwinds in the second half of this year. The other is the global liquidity index, which is also tilting and moving towards a positive direction. And these two things are material drivers of asset prices. So, I think it's important to just separate what's happened geopolitically and what's likely to happen from a liquidity perspective, because ultimately those are what drive asset prices. So I've been watching all those variables. As always, I continue to appreciate the trust that you place in me and my team, and we look forward to continuing to put you in the right position for what we anticipate going forward. As always, please feel free to reach out to Eva or I, book a meeting. Happy to have a call, give you an update. As always, have a great rest of the week. Enjoy the weekend, and look forward to providing a brief update next week as well. Thanks, everybody. Take care.